Imagine for a moment that you are handed a novel. It's a thriller, filled with promises of intrigue, a brilliant protagonist, and a world-changing conclusion. On the first page, the hero, a charismatic and wildly successful CEO, writes you a personal letter. He tells you about the incredible journey you're about to witness, the challenges that have been overcome, the monumental victories achieved, and the glorious, profitable future that lies just a few chapters ahead. You read his words, and you feel a sense of excitement, of confidence. This is a story you want to be a part of. You're already bought in, you're already a believer. Now, with that glowing endorsement echoing in your mind, you begin to read the story. Every dark alley, every suspicious character, every ominous warning is filtered through the lens of that initial promise. You're primed to see success, to forgive missteps, to believe in the happy ending that was guaranteed on page 1. This is how 99% of all investors, from the retail beginner to the seasoned professional, read a company's annual report. They start with the letter to shareholders. They allow themselves to be seduced by the corporate narrative, the grand vision spun by a master storyteller. They get anchored to the optimism before they've examined a single piece of cold, hard evidence. Warren Buffett, the man who built a fortune of over $100 billion from the raw material of financial statements, does the exact opposite. He understands a fundamental truth about human nature and corporate behavior. The story is told in the front, but the truth is buried in the back. Buffett's secret, a principle so simple yet so profound it can single-handedly transform your entire approach to investing, is to read the book backwards. He doesn't start with the hero's promise. He starts in the appendices, in the fine print, in the section that most people find so boring and impenetrable that their eyes glaze over just thinking about it. The footnotes to the financial statements. He becomes a detective before he allows himself to become a fan. He gathers the forensic evidence first, understanding that the numbers and their detailed explanations cannot lie with the same ease as a charismatic leader with a stock option package tied to your belief. This single act of inversion, of starting where everyone else finishes, is a shield against the most costly mistake in the market, falling for a beautiful story that is financially bankrupt. It is the key to transforming yourself from a passive consumer of corporate propaganda into a financial detective, an expert in due diligence who can spot the hidden dangers and corporate disasters long before they make the headlines. This is not just a technique. It is a complete philosophical shift. It is the final promise you make to yourself as a serious steward of your own capital. You will seek the unvarnished truth before you ever listen to the practiced pitch. The journey we are about to embark on is a masterclass in this philosophy. We will deconstruct this principle into 5 essential pillars, turning you into a forensic accountant of the highest order. We will move through an annual report the Buffett way, from the deepest, darkest corners of the footnotes, through the jargon-filled maze of the management discussion, across the cold plains of the core financial statements, and only then, armed with an arsenal of facts, will we confront the CEO's letter. By the end of this analysis, you will never look at a glossy corporate document the same way again. You will possess an analytical edge that can protect your wealth, enhance your financial freedom, and fundamentally change the way you conduct stock research for the rest of your life. Our first pillar is the bedrock of this entire system, the foundation, the core reason for this act of inversion. We must understand not just the how, but the profound why behind the principle of starting with the footnotes. It's about building your house on the solid rock of fact, not the shifting sands of narrative. To truly grasp the power of this idea, we must travel back to a moment of crisis, a time when a national panic threatened to bring down a corporate icon, and a young Warren Buffett, by focusing on the grubby, overlooked details, found one of the greatest investment opportunities of his career. The year was 1963. The company was American Express, and the crisis was born from the most bizarre of commodities: salad oil. A company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis, had perpetrated one of the greatest frauds in modern history. DeAngelis had discovered a simple, brilliant scam. He would borrow massive amounts of money from banks and financial institutions, using his vast inventory of salad oil as collateral. The lenders, including a subsidiary of American Express that ran a field warehousing business, would issue receipts for the oil, which DeAngelis would then use to get more loans. The problem was, the oil wasn't there. His giant tanks, supposedly filled to the brim with millions of pounds of valuable oil, were mostly filled with water. A thin layer of salad oil floated on top, fooling the inspectors. When the fraud was discovered, Allied Crude collapsed overnight, defaulting on loans worth over $175 million, a colossal sum at the time. Panic erupted on Wall Street. American Express, the blue-chip stalwart, the trusted name in travelers' checks and credit cards, was on the hook. Its subsidiary had guaranteed the receipts for the non-existent oil. The market's reaction was swift and brutal. The narrative was simple. American Express was going to go bankrupt. The potential liabilities were enormous, possibly greater than the entire net worth of the company. Investors, gripped by fear, dumped the stock. The price was slashed in half. The CEO's assurances, the company's long history, none of it mattered. The story in the headlines was one of imminent doom. This is where the 99% of investors stopped their analysis. They read the headline, felt the fear, and they sold. But Warren Buffett, then a young, relatively unknown money manager in Omaha, decided to read the story backwards. He decided to ignore the screaming narrative and go straight to the footnotes of the real world. His version of forensic accounting wasn't just in a library, it was on the streets. He did the hard, boring, unglamorous work that no one else was willing to do. He went to restaurants and banks. He stood on street corners and observed customers. He wanted to understand the fundamental reality of American Express's core business, the part of the story that the salad oil scandal was completely obscuring. He talked to merchants. Did they still trust the American Express brand? Yes, absolutely. The scandal was seen as a bizarre, isolated event in a strange corner of the company. He talked to travelers. Were they still using the travelers' checks? Yes, more than ever. He talked to competitors and bankers, asking them if they saw a change in the company's competitive position. The answer was a resounding no. What Buffett discovered through this real-world due diligence was that the company's primary businesses, the credit card and the traveler's check, had an immensely powerful and durable competitive moat. Their brand, their relationship with customers and merchants, was so strong that the market was completely mispricing the damage from the salad oil fraud. He dug into the company's financials, separating the healthy, dominant core from the wounded subsidiary. He realized that even if American Express had to pay every single dollar of the fraudulent claims, the company would survive and its core earning power would remain intact. The market was pricing in death, but the fundamentals screamed survival and future prosperity. He famously loaded up, investing 40% of his partnership's capital into American Express stock. It became one of the cornerstone investments that built his legend and made his partners rich. The lesson is monumental. The market was obsessed with the dramatic, terrifying story on the front page. Buffett ignored it. He went directly to the footnotes of the business, the real-world interactions, the underlying strength of the brand, the actual numbers away from the scandal, to find the truth. Starting your analysis with the footnotes of an annual report is the modern, accessible equivalent of what Buffett did in 1963. It is a deliberate act of ignoring the sensational, emotionally charged narrative until you have first established a baseline of factual, boring, unassailable reality. The power of this inversion is rooted in a deep understanding of behavioral psychology. The specific cognitive bias that Buffett's method is designed to neutralize is called the anchoring bias, combined with the primacy effect. Our brains are not perfect, logical computers. They take shortcuts. The primacy effect dictates that we tend to remember and give more weight to the information we receive first. The anchoring bias is a close cousin. It describes our tendency to rely heavily on an initial piece of information, the anchor, when making decisions. When you start an annual report with the CEO's letter, you are willingly swallowing an anchor. That letter is a masterwork of professional communication, crafted by public relations experts to be as optimistic and compelling as possible. It will highlight every victory, downplay every weakness, and paint a picture of a future so bright you'll need sunglasses. This becomes your anchor. Let's say the CEO writes glowingly about a record-breaking year for revenue. That positive anchor is now set in your mind. Later, when you're deep in the footnotes and you discover that the company's debt tripled, that their accounts receivable are ballooning, and that they're facing a potentially catastrophic lawsuit, your brain has to fight against the initial anchor. Instead of seeing these as giant, waving red flags, the anchored brain tends to rationalize them. Well, the debt must be for good investments because the CEO said things are great. The receivables are probably just a short-term issue. Revenue is at a record after all. You're no longer an objective analyst. You're an apologist for a story you've already decided to believe. Starting with the footnotes completely shatters this process. There is no anchor. There is no story. There is only dense, difficult, and brutally honest information. The footnotes are written by lawyers and accountants, not by marketers. Their purpose is disclosure, to comply with regulations from the Securities and Exchange Commission and to avoid lawsuits. They are not trying to sell you anything. When you start here, your first contact with the company is not a story of success. It's a list of potential problems. Contingent liabilities, debt covenants, accounting policy choices, related party transactions. Your anchor isn't a feeling of optimism. It's a healthy, professionally required dose of skepticism. Now, when you eventually work your way forward to the CEO's letter, the dynamic is completely flipped. You are not a believer being sold a story. You are a detective with a list of evidence, cross-examining a person of interest. When the CEO boasts about that record revenue, your mind doesn't just accept it. It immediately cross-references it with the facts you've already gathered. You say revenue was a record, but the footnotes say you changed your revenue recognition policy this year. How much of that record is real, and how much is an accounting gimmick? You say the future is bright, but the footnotes say your biggest customer is in financial trouble. How does that fit your narrative? You are immune to the charm, deaf to the corporate spin, because you are anchored to the facts. This is the essence of risk management at the highest level. You are building an intellectual immune system against corporate propaganda. So how do we translate this powerful theory into a practical, repeatable mental model? Let's build the blueprint, the step-by-step process for applying this in your own stock research. We will call it the inversion protocol. First, you obtain the company's latest annual report, the 10K filing. Don't just look at the slick, glossy PDF on their investor relations website. Go to the SEC's EDGAR database and get the full, unadulterated legal filing. Second, before you read a single word of the business description or the CEO's letter, you will physically scroll or flip to the absolute end of the document. You are looking for a section with a title like Notes to Consolidated Financial Statements. This is your ground zero. Third, your mission for the first hour of your analysis is to live exclusively within these footnotes. You are forbidden from looking at the income statement, the balance sheet, or any of the narrative sections. Your only job is to read the notes. Fourth, and this is the most critical step, you open a separate document or a physical notebook. This is your question log. As you read the footnotes, you are not trying to become an expert on every detail. You are hunting for things that are confusing, unusual, or concerning. Every time you encounter something that makes you pause, you write it down as a question in your log. For example, you see a note about significant accounting policies and read that the company capitalizes software development costs. Your question becomes, how does their policy for capitalizing these costs compare to their competitors? Are they being aggressive to make their earnings look better? You see a footnote about litigation. Your question, what is the maximum potential liability from this lawsuit and how likely is it to occur? You see a note about a large acquisition. Your question, how much goodwill did they add to the balance sheet, and is that asset at risk of being impaired in the future? This question log is the engine of your entire analytical process. By the time you've spent an hour in the footnotes, you won't have answers, but you will have a list of 10, 15, maybe 20 incredibly intelligent and specific questions. These questions now form your roadmap for analyzing the rest of the report. The footnotes have armed you with a list of potential dangers. Your job is now to move backward through the report, from the back to the front, seeking answers to your questions. You have inverted the process from passive reading to active, targeted investigation. The antithesis to this disciplined approach is the path followed by the 99% of investors. This is the path of the headline investor. Their process is reactive, emotional, and narrative-driven. It begins with a story. Maybe they read an exciting article about a company's new product, or they see the stock price soaring and feel the fear of missing out, or they simply admire the company's charismatic CEO. Their first step isn't to go to the 10K. It's to look at a stock chart. Then, they might go to the company's website and read the glossy summary, filled with beautiful graphics and success stories. Finally, they open the annual report and go straight to the CEO's letter, which confirms everything they already want to believe. They are not conducting due diligence. They are seeking confirmation for a decision they have already emotionally made. They scan the income statement, looking for one number, earnings per share or EPS. If it's going up, that's good enough. They might glance at the balance sheet, but they don't really know what they're looking for. The footnotes might as well be written in a foreign language. They are so complex, so boring, so intimidating, that the headline investor simply skips them, assuming that if there were anything truly wrong, someone else, an auditor, a regulator, a big Wall Street firm, would have found it already. This is a catastrophic abdication of personal responsibility. The dot-com bubble of the late 1990s was the great monument to the failure of this approach. Investors were enchanted by stories of new paradigms and companies that were changing the world. They read CEO letters filled with visionary prose about eyeballs, clicks, and network effects. The stories were so compelling that no one bothered to read the footnotes, which would have revealed a simple, devastating truth. These companies had no profits, no positive cash flow, and business models that were hemorrhaging money with no plausible path to profitability. The grand vision in the front of the annual report was completely disconnected from the financial apocalypse detailed in the back. When the stories finally broke, trillions of dollars in shareholder wealth evaporated. The headline investors, the ones who fell for the narrative, were wiped out. The financial detectives, the few who started with the ugly truth in the footnotes, protected their capital and lived to invest another day. The direct financial connection of the inversion protocol is profound and immediate. It fundamentally changes how you approach valuation and, more importantly, risk management. Investing has two parts: figuring out what something is worth and figuring out the probability that you are catastrophically wrong. The 99% focus almost exclusively on the first part. They build complex models to project future earnings and arrive at a precise target price. The problem is, their models are built on a foundation of sand, the unverified narrative from the front of the report. When you start with the footnotes, you are front-loading your risk analysis. You are systematically searching for the hidden icebergs before you ever start calculating how fast the ship can go. A footnote revealing aggressive revenue recognition tells you that the reported earnings, the starting point for most valuations, are of low quality and cannot be trusted. A footnote revealing massive off-balance sheet liabilities tells you that the company's book value is overstated and its debt is understated. A footnote revealing a heavy dependence on a single customer tells you that all future cash flow projections are incredibly fragile. Each of these discoveries, made before you ever fall in love with the company's story, allows you to make a critical adjustment to your valuation. You might apply a higher discount rate to reflect the increased risk. You might use a normalized, lower earnings figure as your starting point. In many cases, you will simply conclude that the company is uninvestable at any price and move on. saving yourself countless hours of wasted analysis and, more importantly, protecting your capital from a permanent loss. This process is the ultimate defense against value traps. Companies that look cheap on the surface based on metrics like the price-to-earnings ratio, but are actually expensive once you factor in the hidden liabilities and risks buried in the footnotes. The financial advantage is not just in finding winners, it's in the ruthless and efficient avoidance of losers. That is the first and most important promise of reading the book backwards. Now that we have laid the foundation, we must acquire the tools to act upon it. It is one thing to decide to venture into the dark forest of the footnotes. It is another to have a map and a compass to navigate it. Our second pillar is the treasure map, deciphering the specific language of footnotes. This is where we move from the why to the what. We will learn to see the footnotes not as a wall of text but as a series of signposts, each pointing toward a potential source of corporate strength or fatal weakness. The story that perfectly illustrates the life or death importance of this skill is the cautionary tale of Sunbeam and its celebrity CEO, Chainsaw Al Dunlap. In the mid-1990s, Al Dunlap was a corporate superstar. He had a reputation as a ruthless, brilliant turnaround artist. His playbook was simple. He would take over a struggling company, fire thousands of employees, close factories, and slash costs to dramatically and quickly boost profits. The stock price would soar, and he would walk away a hero, fabulously wealthy. In 1996, he was brought in to save Sunbeam, a sleepy manufacturer of household appliances. Wall Street was ecstatic. Dunlap promised a miraculous transformation, and for a while, he seemed to deliver. Sunbeam's stock shot up from $12 to over $50 a share. The CEO's letter was a masterpiece of self-congratulation, praising the company's incredible performance. The reported earnings were fantastic. But a small number of skeptical investors, the kind who read annual reports backwards, started to notice something strange. Deep in the footnotes, in the section on accounting policies, they found the clues to a massive deception. One of the most glaring red flags was the company's aggressive use of bill and hold sales. This is an accounting technique where a company books revenue for products that it has sold to a distributor but has not yet shipped. The products are still sitting in the company's own warehouse. While technically permissible under very strict conditions, it is a giant red flag for financial manipulation. A forensic accountant reading that footnote would immediately ask a critical question. Why would a customer buy millions of dollars of grills and blenders and ask you to hold on to them? Don't they want the product so they can sell it? The logical answer is that they don't. Sunbeam, under immense pressure from Dunlap to make the numbers, was essentially forcing its distributors to take on massive amounts of inventory they didn't need. They would offer huge discounts and generous credit terms to convince them to place massive orders at the end of a quarter, allowing Sunbeam to book the revenue and hit Wall Street's targets. The footnote was the clue that the company wasn't selling products to end consumers, it was just stuffing its sales channel. The detectives didn't stop there. They noticed other tricks. They saw accounts receivable, the money owed to Sunbeam by its customers, climbing much faster than sales, a classic sign that customers aren't paying their bills. They saw inventory levels of finished goods mysteriously decreasing, even as sales were supposedly soaring, which hinted that the company might be selling products at a loss just to book the revenue. Each of these clues was a thread, and when pulled, they unraveled the entire fraudulent narrative. The spectacular earnings weren't real. They were an accounting fiction, a house of cards built on pulling future sales into the present. In 1998, the truth finally came out. The scheme collapsed, Sunbeam's stock plunged to near zero, the company went bankrupt, and Al Dunlap was fired and barred from serving as an officer of a public company for life. The investors who read the CEO's letter were wiped out. The few who deciphered the language in the footnotes saved themselves from disaster. The psychological principle at play here is a powerful one that keeps most people from ever finding these clues, a combination of complexity bias and information aversion. Our brains are inherently lazy. They are designed to conserve energy. When faced with something that is complex, dense, and written in technical jargon, our natural instinct is to shy away from it. This is information aversion. We avoid the cognitive strain. The footnotes of an annual report are a perfect example. They are deliberately written by lawyers and accountants in a way that is precise but not necessarily easy to understand. The average person sees this wall of text and their brain screams, "This is too hard! Skip it!" This is compounded by complexity bias, our tendency to feel that complex solutions or descriptions are better than simple ones. When we see the dense, legalistic language of the footnotes, we subconsciously assume that it must have been written by very smart experts and vetted by other experts, and therefore it must be correct and we don't need to worry about it. We outsource our thinking to the auditors and regulators. We see that the company's auditor, a big, reputable firm, signed off on the financial statements, and we take that as a guarantee that everything is fine. This is a mental trap. Buffett's approach is about actively fighting these biases. It is about embracing the complexity, knowing that it is often a place where companies hide inconvenient truths. The more complex and confusing a footnote is, the more important it is to understand it. Simplicity and clarity are the hallmarks of an honest management team. Complexity and obfuscation are giant red flags. To turn this into an actionable blueprint for your own due diligence, we can create a forensic accountant's checklist, a guide to the most critical notes you need to examine. This is your treasure map. First, go to Note 1, Summary of Significant Accounting Policies. This is the company's rulebook. Pay special attention to revenue recognition. Do they recognize revenue at the point of sale, or are they using aggressive techniques like bill and hold? How do their policies compare to their direct competitors? A company with a more aggressive policy than its peers is a warning sign. Also, look at their policy for inventory, specifically LIFO, last in, first out, versus FIFO, first in, first out. In a period of rising prices, a company using LIFO will report lower profits but have a more realistic balance sheet. Understanding their choice tells you if they are trying to maximize reported earnings or present a more conservative picture. Second, find the footnote on debt. Don't just look at the total amount, look for the debt covenants. These are rules the company must follow to avoid defaulting on its loans, things like maintaining a certain level of cash flow or keeping its debt-to-equity ratio below a specific number. You need to ask, how close is the company to violating these covenants? A small dip in business could put them in technical default, giving lenders the power to demand immediate repayment, which can be a death sentence. Third, look for the footnote on contingencies and litigation. This is where the company discloses pending lawsuits. The company will almost always say that they believe the outcome will not have a material adverse effect. Ignore that boilerplate language. Look for the potential range of loss. Is there $1 billion lawsuit that could wipe out the company's entire net worth? This is a risk that is not on the balance sheet, but it is very, very real. Fourth, search for notes on off-balance sheet entities or special-purpose vehicles. This was the primary weapon used by Enron to hide billions of dollars in debt. These are complex legal structures that allow a company to keep massive liabilities off its main balance sheet, making it look much healthier than it actually is. If a company is using these extensively, it is a 5-alarm fire. Fifth, examine the footnote on pensions and other post-retirement benefits. For older industrial companies, this can be a hidden time bomb. Many have promised generous pension benefits to their employees for decades. If the pension plan's assets are less than its future obligations, the plan is quote, 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 and the company is on the hook for the difference. This is a real debt, just like a bank loan, that can be a massive drag on future cash flows. Finally, look for the note on related party transactions. This details any business the company does with its own executives, board members, or their families. Is the company leasing its headquarters from a real estate firm owned by the CEO's brother-in-law? While not always improper, these transactions create massive conflicts of interest and must be scrutinized with extreme prejudice. This checklist is your starting point for becoming a true financial detective. The antithesis of this deep dive approach is what we can call the trusting the auditor fallacy. The average retail investor sees the clean audit report from a major accounting firm and thinks it's a seal of approval, a guarantee that the company is a safe and sound investment. This is a fundamental misunderstanding of what an auditor does. An auditor's job is not to tell you if a company is a good investment. Their job is simply to provide an opinion on whether the financial statements are prepared, in all material respects, in accordance with Generally Accepted Accounting Principles, or GAAP. Think of GAAP as the rules of the road for accounting. You can follow all the traffic laws and still drive your car straight into a wall. A company can be perfectly compliant with GAAP and still be a terrible business on the verge of bankruptcy. Furthermore, GAAP offers companies a wide degree of latitude in how they account for things. The choice between aggressive and conservative accounting policies is still within the rules. The auditor will sign off on either one. The spectacular collapse of Wirecard, a German payments company, is a perfect modern example. For years, it was a tech darling, and for years, its auditor, Ernst & Young, gave it a clean bill of health. But the company was a complete fraud. Nearly €2 billion in cash that was supposed to be in trustee accounts simply did not exist. The auditors trusted forged documents. The lesson is clear. The auditor is a backstop, not a substitute for your own due diligence. Your wealth management depends on your own analysis, not on blindly trusting a third party's opinion. The footnotes are where you can check the auditor's work. This leads directly to the financial connection, how deciphering footnotes allows you to calculate a company's true, tangible book value. The balance sheet you see in a report is just a starting point. It's an accounting representation of the business, not necessarily its economic reality. The footnotes are where you find the information to make critical adjustments. For example, a company might list goodwill as a multi-billion-dollar asset on its balance sheet. Goodwill is created when a company acquires another business for more than the fair market value of its assets. It represents intangible things like brand reputation or customer relationships. But the footnote on goodwill might tell you that it all came from one big, overpriced acquisition made at the peak of the market. As a skeptical analyst, you might decide that the true economic value of that goodwill is zero and subtract it entirely from the company's book value. You can do the same with the pension liability. You would add the underfunded portion of the pension plan to the company's liabilities, reducing its true net worth. You can analyze the accounts receivable and decide that a certain percentage is unlikely to be collected and write it down. After making these forensic adjustments based on your investigation of the footnotes, you arrive at a much more conservative, much more realistic measure of the company's net worth. You may discover that a company with a positive reported book value actually has a negative real tangible book value. This is an immense analytical edge. While other investors are valuing the company based on the official rosy numbers, you are valuing it based on a harsh economic reality. This is how you avoid paying for phantom assets, and how you identify truly undervalued securities where the assets are real, tangible, and worth far more than the market price suggests. Having mastered the art of extracting truth from the footnotes, we now begin our journey backward, moving up from the deepest level of detail to the next layer of the corporate onion. Our third pillar is the smoke detector, identifying red flags in the management discussion and analysis, or MD&A. This section of the annual report sits between the hard financial statements and the CEO's letter. It is management's opportunity to explain the numbers in their own words, to tell the story of the past year's performance, and provide an outlook for the future. But it is also a minefield of jargon, euphemisms, and carefully crafted sentences designed to obscure as much as they reveal. If the footnotes are the forensic evidence, the MD&A is the interrogation transcript. And to understand its power to mislead, we need only look at the rise and fall of Valeant Pharmaceuticals. In the early 2010s, Valeant was the darling of Wall Street. Its stock price went parabolic, rising over 1,000% in just a few years. Its business model, championed by its CEO Michael Pearson, was simple. Instead of spending money on risky and expensive research and development to discover new drugs, Valeant would grow by acquiring other drug companies and then ruthlessly slashing their R&D budgets and jacking up the prices of their existing drugs. For a time, it worked like a charm. The company's reported earnings, especially its adjusted EPS, grew at a breathtaking pace. If you were a financial detective moving backward from the footnotes, you would have already discovered some alarming facts. You would have seen the colossal, almost unbelievable amount of debt the company had taken on to fund its acquisition spree. You would have seen the massive amount of goodwill on its balance sheet, a testament to the high prices it was paying. Armed with this skeptical knowledge, you would then arrive at the MD&A, and here you would find a masterclass in obfuscation. The MD&A was filled with talk about synergies, operational efficiencies, and shareholder value creation. But the most important deception was its relentless focus on non-GAAP financial metrics. Valeant knew that its official GAAP reported net income looked terrible because it included all the massive costs associated with its acquisitions and restructuring. So they created their own metric, which they variously called adjusted net income or cash EPS. In the MD&A, they trumpeted the incredible growth of this made-up number. But a detective's job is to ask, what are you adjusting for? A close reading of the MD&A and its reconciliation tables would reveal that they were excluding enormous, very real expenses, such as the costs of the acquisitions themselves, the costs of firing thousands of people, and, most egregiously, the amortization of the very drug patents they were buying. They were essentially asking investors to value the company as if the cost of acquiring its core assets was not a real expense. It was like buying a house and then calculating your personal profit without including the cost of the mortgage. It was a complete fantasy. The MD&A was the smoke machine, pumping out a fog of confusing, non-standard metrics to hide the fire of a business model that was fundamentally unsustainable and built on a mountain of debt. When the model finally broke, the stock collapsed by over 90%, destroying tens of billions of dollars in shareholder value. The MD&A was where the company told its misleading story, and only a skeptical reading could have protected you. The psychological principle that management exploits in the MD&A is our brain's vulnerability to euphemistic language and strategic obfuscation. A euphemism is a mild or indirect word or expression substituted for one considered to be too harsh or blunt when referring to something unpleasant or embarrassing. Corporate communication is built on euphemisms. A company doesn't have falling sales, it is facing economic headwinds. It doesn't fire 10,000 people. It engages in a strategic workforce realignment to capture synergies. It doesn't admit our last big product launch was a total failure. It reports higher than expected marketing expenses related to new product support. This language is carefully chosen to anesthetize the reader's critical thinking. It sounds professional, intelligent, and reassuring. It doesn't trigger the same alarm bells in our brain as plain, direct language would. Obfuscation is the other side of the coin, making things deliberately complex and unclear. By using convoluted sentences, undefined acronyms, and a blizzard of non-GAAP metrics, management can create a high cognitive load for the reader. This ties back to the principle of information aversion. Faced with a paragraph that is nearly impossible to decipher, most people will simply give up and skip it, assuming it's not important. But the detective knows that the more confusing a passage is, the more likely it is that it's hiding something important. The goal of a forensic reading of the MD&A is to become a translator, converting the company's sanitized corporate speak back into plain, harsh English. To do this effectively, you need a specific mental model. Let's call it the jargon translator technique. This is a practical, step-by-step method for cutting through the fog. First, and most importantly, whenever you see a non-GAAP metric like adjusted EBITDA or cash EPS, your hunt begins. Do not accept this number at face value. Scroll through the document until you find the reconciliation table that shows how the company got from its official GAAP net income to its preferred non-GAAP number. Then, scrutinize every single line item they excluded. Are they excluding stock-based compensation? That is a very real expense that dilutes existing shareholders. Are they excluding restructuring charges? If a company has restructuring charges every single year, it's not a one-time event, it's a sign of a chronically mismanaged business. Your job is to decide which of their adjustments are legitimate and which are pure fantasy, and then calculate your own, more realistic version of the company's earnings. Second, apply the adjectives versus verbs test. Read a paragraph of the MD&A and highlight all the positive subjective adjectives management uses. Words like strong, robust, excellent, successful. Now look at the actual numbers and facts they present, the verbs of the business. Do the facts support the adjectives? If management describes a strong performance in a segment where revenue grew by only 1%, you have a disconnect. This tells you that management is trying to spin a mediocre reality into a positive story. Third, use the Control-F test. Take your digital copy of the 10K and use the search function to find key risk words. Search for competition. How do they describe their competitive landscape? Are they honest about the threats, or do they dismiss their rivals as insignificant? Search for customer concentration or dependence. Do they disclose if a huge percentage of their revenue comes from just one or two customers? The loss of a single one of those clients could be devastating. Search for regulation. What new laws or rules are on the horizon that could impact their business? The way management discusses risks is often more telling than the way they discuss successes. Finally, compare this year's MD&A to last year's. Did they change their definition of a key metric without explanation? Did a major risk factor that they discussed at length last year suddenly disappear, even though the risk still exists? These year-over-year changes can be incredibly revealing and are often where companies try to hide deteriorating performance. The path of the 99%, the antithesis of this deep analysis, is what we can call the believing the hockey stick problem. The MD&A is often where management will lay out its vision for the future, frequently accompanied by charts that show a hockey stick trajectory, a period of flat or modest growth, followed by a sudden, dramatic, and sustained upward explosion. The average investor, already primed by the CEO's optimism, gets captivated by this projection. They mistake management's hopes and dreams for a credible forecast. They start to build their own valuation models based on these fantastically optimistic assumptions. They fail to ask the tough, skeptical questions that a detective would ask. What specific concrete things have to go right for this hockey stick projection to become a reality? What is management's track record of accurately forecasting its own business? Have their past projections panned out, or have they consistently overpromised and underdelivered? They take the story at face value. This is especially dangerous with young, speculative companies, like a biotech firm with no revenue that projects billions in sales from a drug that is still in early-stage trials. Believing the hockey stick is a form of narrative-driven investing that is completely untethered from the probable realities of the business. It's a recipe for disappointment and financial loss. The direct financial connection of a forensic MD&A analysis is the ability to assess the quality of earnings. The net income number on the income statement is not a single, unambiguous fact. There is high-quality income, and there is low-quality income. High-quality earnings are sustainable, repeatable, and come from the company's core operations. Think of a company like Coca-Cola selling more beverages this year than last year. That's high quality. Low-quality earnings are driven by one-time events, accounting gimmicks, or unsustainable actions. Examples include a profit boost from selling a factory, a change in accounting assumptions that reduces reported expenses, or a temporary surge in income from cutting the R&D budget, which jeopardizes the company's future. The MD&A is the primary text you use to perform this quality of earnings analysis. By translating the jargon and understanding the non-GAAP adjustments, you can determine if the company's reported profit is real or manufactured. This assessment directly impacts the valuation you place on the business. High-quality, recurring earnings deserve a high multiple in the stock market. Investors are willing to pay a premium for predictability and safety. Low-quality, manipulated, or one-time earnings deserve a very low multiple, or perhaps no multiple at all. A company that can only grow its EPS through accounting tricks is not growing its intrinsic value. By dissecting the MD&A, you can distinguish between a healthy, growing business and a financial mirage. This skill allows you to avoid overpaying for low-quality businesses and to identify the high-quality compounders that are the true source of long-term wealth creation. We have now risen from the depths of the footnotes and navigated the fog of the MD&A. Our hands are dirty with forensic evidence, and our minds are armed with a healthy skepticism. Now we arrive at the main event, the place most people start but where our detective work reaches its critical phase. Our fourth pillar is the final check, using the financial statements as a polygraph. The three core statements, the income statement, the balance sheet, and the cash flow statement, are the heart of the annual report. For the average investor, they are just a collection of numbers. For the financial detective, they are the three needles of a polygraph machine, and when analyzed together, they can reveal the truth or expose a lie with brutal clarity. The definitive case study for this principle is the scandal that brought down a titan of the telecommunications industry, WorldCom. At the turn of the millennium, WorldCom was a corporate giant. Its CEO, Bernie Ebbers, was a folksy, charismatic empire builder who had stitched together dozens of companies to create a telecom behemoth that rivaled AT&T. The company's stock was a Wall Street darling, and its reported earnings grew year after year with what seemed like unstoppable momentum. The income statement, viewed in isolation, was a thing of beauty. Profits were consistently and impressively rising. Most investors looked no further. They saw the rising earnings per share and they bought the stock. They believed the story. But a detective, applying the polygraph test, would have immediately seen a fatal inconsistency. The key is to never look at one statement in isolation. You must always triangulate them. The most powerful triangulation is the relationship between the income statement and the statement of cash flows. Net income, the bottom line of the income statement, is an accounting opinion. It is subject to manipulation through a host of assumptions and estimates. Cash flow from operations, however, is a fact. It is the cold, hard cash that the business generated. In a healthy, honest company, net income and cash flow from operations should track each other closely over time. They should move in the same general direction. At WorldCom, they were screaming in opposite directions. While the company was reporting massive, growing profits on its income statement, its cash flow from operations was stagnant, and in some periods even negative. This is a red flag the size of a planet. It's the polygraph needle flying off the chart. It begs the most important question in financial analysis. If you're so profitable, where is the cash? The answer, discovered far too late by most, was one of the largest accounting frauds in history. WorldCom was taking its normal everyday operating expenses, specifically the fees it paid to lease phone lines from other carriers, and fraudulently classifying them as capital expenditures. This simple trick had a magical effect on the income statement. A regular operating expense is subtracted from revenue immediately, reducing profit. A capital expenditure, however, is treated as a long-term asset on the balance sheet and is then depreciated slowly over many years. By reclassifying billions of dollars of expenses, WorldCom artificially inflated its reported profits and its assets. The fraud was plain to see for anyone who compared the income statement to the cash flow statement. The cash was still going out the door to pay the line leasing fees. That reality couldn't be hidden on the cash flow statement. The divergence between profit and cash was the definitive tell. When the fraud was uncovered in 2002, the company collapsed into bankruptcy, and its stock became worthless. The polygraph had been screaming the truth for years, but only those who knew how to read it were listening. The psychological bias at play here is a familiar and powerful one: confirmation bias. By the time an average investor gets to the financial statements, they have usually already made up their mind. They've read the exciting story, they've seen the charismatic CEO on TV, they've been anchored by the optimistic letter. They are not looking at the financial statements for objective truth. They are looking for evidence to confirm the belief they already hold. They see the rising EPS on the income statement and think, aha, I knew this was a great company. They ignore or rationalize away any conflicting information, like poor cash flow, because it creates cognitive dissonance with their pre-existing conclusion. The read it backwards methodology is the ultimate antidote to confirmation bias. You arrive at the financial statements not with a positive conclusion to confirm, but with a list of skeptical questions from the footnotes and the MD&A. You have a hypothesis that something might be wrong. You are not looking for confirmation. You are actively looking for disconfirmation. You are using the financial statements to test your skeptical theories. The footnotes mentioned aggressive revenue recognition. Let's see if accounts receivable on the balance sheet are growing faster than sales. The MD&A seem to be hiding something about their debt. Let's look at the financing section of the cash flow statement to see how much new debt they actually took on this year. This is the scientific method applied to investing. You form a skeptical hypothesis, and then you try to disprove it with the hard data from the financial statements. So let's build the blueprint for this polygraph test. We'll call it the statement triangulation method. It has 3 core steps. Step 1 is the WorldCom test, the income to cash flow bridge. Always start by plotting net income and cash flow from operations on the same chart for the last 5 to 10 years. In a healthy business, these 2 lines should look like a pair of dancers, moving together. If you see a crocodile jaw pattern where the net income line is soaring upwards while the cash flow line is flat or heading down, you have found a major anomaly that must be investigated until you have a satisfactory explanation. Why is profit not turning into cash? Step 2 is the balance sheet health check. Here you are looking for signs of operational strain or financial weakness. A key technique is to look at working capital accounts relative to sales. Are accounts receivable growing faster than revenue? This could mean the company is extending lax credit terms to book sales, and many of these sales may never be collected. Is inventory growing faster than revenue? This could mean the company's products aren't selling, and they are headed for a big write-down. Another crucial check is goodwill. Look at goodwill as a percentage of total assets. If it's a very high number, it tells you the company's value is heavily dependent on the success of past acquisitions. This is a risky position, as a failed acquisition can lead to a massive goodwill impairment charge, which will destroy shareholder equity. Step 3 is the debt X-ray. You must understand how the company is using and managing its debt. Look at the cash flow statement under cash flow from financing. Is the company consistently issuing new debt year after year? What are they using the money for? Are they using debt to fund their day-to-day operations because their business isn't generating enough cash on its own? This is a sign of a company on life support. Are they issuing debt to buy back their own stock at record-high prices? This is often a sign of a management team focused on short-term stock price boosts, rather than long-term value creation. Finally, compare the total debt from the balance sheet to the cash flow from operations. This is the debt to CFO ratio. It tells you how many years it would take for the company to pay off all its debt using the cash it generates from its business. A high or rapidly rising number is a clear warning of increasing financial risk. The antithesis to this rigorous multi-statement approach is the EPS is everything mentality. This is the single greatest error made by the 99% of investors. They are conditioned by the financial media, by Wall Street analysts, and by corporate press releases to focus on one single number, quarterly earnings per share. They see the world through this tiny, easily manipulated keyhole. CEOs know this, and their compensation is often tied directly to hitting EPS targets. This creates a perverse incentive to do everything in their power to make that one number look good, even if it comes at the expense of the long-term health of the business. A company can easily manipulate its EPS. They can buy back shares of their own stock, which reduces the number of shares outstanding and therefore magically increases the earnings per share, even if the company's total net income has not grown at all. They can cut vital long-term investments in research or marketing to boost short-term profits. They can use any of the accounting tricks we've discussed to manufacture earnings. The investor who is focused only on EPS is blind to all of this. They are watching the scoreboard, but they have no idea what is actually happening on the playing field. They are making themselves an easy mark for a savvy but unscrupulous management team. The direct financial connection of the statement triangulation method is its ability to lead you to the holy grail of value investing, a realistic calculation of free cash flow. While earnings are an opinion, and cash flow from operations is a fact, free cash flow is the ultimate truth. Free cash flow is the cash generated by the business after subtracting the capital expenditures necessary to maintain and grow its asset base. It is the surplus cash that is available to be distributed to the company's owners, the shareholders. It is the true source of a company's intrinsic value. Your forensic analysis of the three statements together is what allows you to calculate a legitimate free cash flow number. You start with cash flow from operations, which you've already verified is a more reliable figure than net income. Then you look at the capital expenditures. Are they reasonable? Is the company spending enough to maintain its competitive position? Or are they starving the business of capital to make their free cash flow look better temporarily? By analyzing the quality of earnings and the balance sheet trends, you can make intelligent adjustments to arrive at a normalized, sustainable free cash flow number. This number is the single most important input in any discounted cash flow (DCF) valuation, which is the theoretical foundation for determining what a business is truly worth. An investor who cannot confidently calculate a company's free cash flow is simply guessing. The statement triangulation method turns guessing into a disciplined process of discovery, bringing you as close as possible to the economic reality of the business. And so our journey backwards is nearly complete. We have crawled through the trenches of the footnotes, fought our way through the smoke-filled rooms of the MD&A, and run our polygraph test on the financial statements. We are armed with facts, fortified by skepticism, and prepared for the final encounter. We now arrive at the very beginning of the annual report, the place where everyone else starts their journey, but where ours concludes. Our fifth and final pillar is the last deception, deconstructing the CEO's letter. Having done the hard work, we can now read this letter not as a piece of marketing to be consumed, but as a piece of evidence to be cross-examined. There is no better illustration of this final clarifying step than reading the last shareholder letters of Kenneth Lay, the chairman of Enron. Reading Ken Lay's letters to shareholders from the years leading up to Enron's catastrophic 2001 collapse is, with the benefit of hindsight, a surreal experience. But for a detective who had just completed a backward analysis of Enron's 10K, it would have been a chilling one even at the time. A deep dive into Enron's footnotes would have revealed a nightmarish web of thousands of off-balance sheet special-purpose entities. The MD&A was a monument to deliberate obfuscation, filled with jargon about merchant investments and complex hedging structures that were impossible to comprehend. And a triangulation of the financial statements would have shown a company with weak, erratic cash flow, despite its claims of smooth, predictable earnings from energy trading. After uncovering all of this evidence pointing to a company that was, at best, incomprehensibly complex and, at worst, a complete fraud, you would then turn to page 1 and read Ken Lay's letter. You would read words about integrity, transparency, and innovation. You would read about Enron's vision to create open, transparent markets for everything from electricity to broadband capacity. You would read a story of a sleek, modern, asset-light company that was leading the world into a new economic era. The disconnect between the beautiful, inspiring story in the front and the terrifying, convoluted financial reality in the back would be so profound, so absolute, that it would serve as the final, definitive confirmation that something was catastrophically wrong. The CEO's letter, read last, is not an introduction. It is a verdict. It is the ultimate test of management's credibility. In Enron's case, it revealed a leadership that was either completely delusional or pathologically deceptive. Either conclusion would be a clear signal to sell any shares you owned and never look back. The psychological principles that this final step short-circuits are the most powerful of all: the halo effect and authority bias. We are socially conditioned to defer to and trust people in positions of power and authority. A CEO of a major public company is a high-authority figure. Authority bias makes us automatically assign more credibility to their words. The halo effect is our tendency to let one positive trait of a person, like their charisma or their track record of success, influence our judgment of their other traits. If a CEO is seen as a brilliant visionary, we are predisposed to believe that their letter to shareholders is honest and accurate. When you read the letter first, you are a willing victim of these biases. You are a humble student listening to the wisdom of a celebrated master. Your critical faculties are lowered and you are ready to believe. But when you read the letter last, after your exhaustive forensic investigation, you have completely inverted this power dynamic. You are no longer the student, you are the prosecutor. The CEO is no longer the master. They are a witness on the stand whose credibility has already been called into question by a mountain of financial evidence. You are not reading for inspiration. You are reading for inconsistencies. The halo effect is shattered. You are not judging the numbers based on the CEO's glowing words. You are judging the CEO's words based on the cold, hard numbers. This final act of inversion protects you from the most potent form of corporate persuasion and completes your transformation into a truly independent financial thinker. To systematically deconstruct the CEO's letter, we can use a mental model called the Berkshire Hathaway litmus test. Warren Buffett's own annual letters to his shareholders are widely considered the gold standard of corporate communication. They are models of clarity, candor, and shareholder-friendly thinking. By comparing any CEO's letter to the Buffett standard, we can quickly judge its quality and the integrity of its author. The test has 5 key questions. First, does the CEO demonstrate an ownership mentality? Read the letter and ask, does this person write like a partner who sees me, the shareholder, as a fellow owner? Or do they write like a hired manager, a bureaucrat reporting to a distant boss? Buffett is famous for talking about our capital and our business. He sees himself as a steward of his partner's money. Look for that owner-like language. Be wary of a CEO who talks more about the company or the stock price than about the underlying business that you collectively own. Second, does the letter display candor about mistakes? No business and no CEO is perfect. Every year has its challenges and its failures. Buffett's letters are famous for the sections where he openly, and often humorously, details the mistakes he made during the year. This is the ultimate sign of a confident, honest leader. Contrast this with the typical CEO letter, which is a sanitized highlight reel of only the good news. A letter with no admission of error is a letter that cannot be trusted. Third, does the letter prioritize clarity over jargon? Buffett writes in plain, simple English. He has said he pretends he is writing to his sisters, who are intelligent people but not financial experts. He uses analogies and clear prose to explain complex business concepts. If you read a CEO's letter and it is filled with impenetrable MBA speak, buzzwords, and corporate jargon, it is not because the concepts are too complex for you to understand. It is because the CEO is either a poor communicator or is deliberately trying to confuse you. As Buffett says, it's not a sin to be a B student, but it is a sin to hire a C student to write your annual report. Fourth, what is the focus of the letter? Does the CEO focus on the long-term, per-share intrinsic value of the business? Do they discuss durable competitive advantages, capital allocation decisions, and the health of the balance sheet? Or is the letter obsessed with short-term metrics, like the quarterly stock price performance, and hitting Wall Street's EPS estimates? A great CEO is focused on building business value over decades. A mediocre CEO is focused on managing Wall Street's expectations over the next 90 days. The letter will reveal their true priority. Finally, apply the pronoun test. Do a simple count of the number of times the letter uses the pronoun I versus the pronoun we. While not a perfect science, an overwhelming number of I's can be a red flag for a narcissistic, self-aggrandizing leader who sees the company as their personal fiefdom. A leader who consistently uses we is more likely to have a collaborative, team-oriented mindset. The antithesis to this critical deconstruction is the powerful and dangerous phenomenon of the cult of the visionary CEO. This is when investors stop investing in a business and start investing in a personality. They fall in love with a charismatic storytelling leader. They buy the vision, they buy the myth, and the CEO's letter becomes their gospel. The company's stock is no longer a claim on the underlying assets and cash flows of a business. It is a bet on the genius of a single individual. We saw this with Adam Neumann at WeWork, whose messianic vision of changing the world's consciousness through office rentals captivated investors long after the company's financials showed it to be a simple, wildly unprofitable real estate company. We see it with many celebrity CEOs, whose every pronouncement is treated as infallible. This type of investing can be incredibly thrilling and, for a time, even incredibly profitable. But it is inherently fragile. When the narrative breaks, when the visionary leader makes a critical mistake or is revealed to be all too human, the fall can be catastrophic, because the investment was never supported by a foundation of financial reality. The Berkshire Hathaway litmus test is a shield against this kind of personality-driven investing, forcing you to ground your analysis in the substance of the communication, not the style of the communicator. And this brings us to the final and most important direct financial connection. The CEO's primary job is not to be a visionary or a celebrity. The CEO's primary job is to be the chief capital allocator of the business. Their long-term success or failure will be determined by how well they allocate the cash generated by the company. They have 5 basic options: reinvest in the core business, acquire other businesses, pay down debt, issue dividends, or buy back shares. The CEO's letter, when read last, is the ultimate report card on their capital allocation skill and philosophy. You have already seen the results of their past capital allocation decisions. You saw it in the footnotes on acquisitions. You saw it in the goodwill on the balance sheet. You saw it in the debt levels and the share count on the financial statements. You have seen the what. The CEO's letter now gives you the why. You get to read their explanation for the decisions they made. Did they make a huge acquisition? Here, they will tell you why they thought it was a brilliant move. Did they spend billions on share buybacks? Here, they will explain why they thought the stock was undervalued. Your job as a fully informed detective is to judge their reasoning. Does their explanation align with the financial reality you have already uncovered? Or does it reveal a CEO who is focused on ego-driven empire building, who overpays for acquisitions, or who foolishly buys back stock at peak prices? This final step connects the numbers directly to the executive decision-making process. It allows you to judge the quality of the management team, which, over the long run, is the single most critical factor in the compounding of your investment. It is the final piece of the puzzle, the completion of a truly comprehensive business analysis. You have just completed a rigorous mental workout. You have fundamentally rewired the way you will approach corporate documents for the rest of your life. You've moved beyond the surface-level narratives and learned to operate as a financial detective, a forensic analyst who starts with the hard evidence buried in the back. This isn't just a trick or a technique. It is a powerful mental model, a shield that will protect your capital from the hype, the fraud, and the subtle deceptions that cause most investors to lose. You now possess the ability to see what others miss, to understand the true risks of a business before they ever hit the headlines. This is a massive analytical edge, and you have earned it. But it is crucial to understand that this powerful tool you've just mastered, the art of reading a financial report backwards, is just one critical node in a much larger network of mental models that the world's greatest investors use to manage risk and build lasting wealth. Think of it like learning how to read a single, highly detailed map of a city. You've mastered every street and landmark, but this is just one city in a vast and interconnected country. True financial freedom and executive decision-making skill comes from understanding how all the maps fit together, how the highways of capital allocation connect to the cities of forensic accounting. The video that is now appearing on your screen is not just another video, it is the next piece of that larger map. It is the link that connects what you have just learned about finding hidden dangers within a single company to the broader strategies of portfolio construction and long-term risk management. Mastering the analysis of one company is a vital skill, but understanding how to position that company within a diversified portfolio, how to think about market cycles, and how to protect yourself from risks beyond the scope of a single annual report, that is the next level. The information in that video is the bridge between being a great stock picker and being a great architect of your own financial future. The choice to click is not just about watching another piece of content, it is a decision about your own identity. Are you someone who collects interesting tricks? Or are you someone who is committed to building a complete, unbreakable mental arsenal for success? Are you content with mastering a single tactic? Or are you on a path to mastering the entire strategy of wealth creation? This journey requires discipline and a commitment to continuous learning. If you are serious about that journey, if you are truly dedicated to completing your mental toolkit, then you know what you have to do. Continue your ascent. Click the video, and let's connect the next piece of the map.